I'm in accordance with our ESG policies. I'm going to sit over here so that Marilyn stays safe. I hope you guys appreciate my speaking voice because I purposefully inoculated myself with some horrible virus so I'd sound better today. But my name is Josh Deitch, and I'm the group head of fund management and capital for ESR. Throughout the day, we've heard our business leaders describe various key strategic initiatives across the ESR group. All of those initiatives require loyal support from our investor partners to provide critical funding to enable our $6.5 billion of new development starts, as Stuart mentioned in the beginning of the day, or the 560 megawatts of development projects in our seeded pipeline, as Dermot highlighted. Well, fortunately, we believe we've built a unique integrated platform and deep capital relationships to continue to fuel our continued growth into the future. So we'll take you through kind of an update of the capital raising market, an update of ESR on our capital raising side, and then end with our key themes and priorities. And I think it's fair to say, as you've heard consistently today, we're very bullish on our business. However, the poly crisis of the COVID pandemic, the Ukraine war, growing geopolitical tension, rising inflation, rising interest rates has clouded market clarity. And the fundraising market has suffered. Compounding the capital raising challenges, volatile equity markets with a nearly 25% peak to trough values in the Dow and 50% peak to trough on the HKEX last year has exposed denominator effect fears that has deterred new capital deployment. And many investors now are sitting on the sidelines waiting for lower real estate prices. The fundraising data reflect this. Last year in 2022, the $182 billion of private equity real estate capital raised was a 26% drop from 2021, and the second lowest amount raised since 2016, according to Realfin. This investor anxiety has spilled over into the first quarter of 2023 with compounded concerns regarding banking sector stability and the unthinkable US default. Q1 numbers resulted in the lowest capital raised in the first quarter in the past decade at only $26 billion, according to Realfin. However, there are some positive signs. Despite the uncertainty and risk, in Q1, investors seeking to increase or maintain allocations to real estate comfortably outnumbered those looking to retreat, and target real estate allocations have increased from 10.1% to 10.9%. And many investors are sensing opportunities in this vintage. They're just waiting for the opportune moment. To that point, Realfin saw a 62.4% quarter-on-quarter increase in the number of mandates, RFPs, and investor intentions on their platform in Q1. The interest is there. And while the current environment is challenging, we think we are well positioned to capitalize on ESR's competitive advantages in terms of our proven execution, our attractive sectors, geographies, and products. So since before our IPO, and through the dark fundraising clouds of the pandemic, ESR's capital raising has soared. In addition to the $7.6 billion figure that Stuart mentioned of new capital raised last year, we've raised $36.2 billion over the last 5 years. This is a global feat, only surpassed by Blackstone and Brookfield. Since 2008, the annual global unlisted real estate fundraising totals have grown at less than a 5% CAGR, while ESR's annual hauls have grown at a 48% CAGR. And we have now expanded to 119 private investment vehicles comprising $87 billion of AUM, an increase of nearly 3x or $56 billion in value over the past 5 years. This positions ESR as the 6th largest global real estate fund manager and 3rd largest publicly traded in the world. Scale matters, and importantly, we are the #1 largest real asset manager in Asia, which provides a significant advantage as the universe of strong real estate managers, especially those with a key focus on ESG, is much smaller. Just a few statistics to put our competitive position in perspective. Of the $30 billion raised from 79 new APAC real estate funds across all strategies included and tracked by Realfin in 2022, ESR raised nearly 25 cents of every dollar and approximately 30 cents of every core real estate dollar raised in Asia. That is sizable market share in this massive market. Our company has evolved from a merchant developer into a fully integrated institutional operator and fund manager. The capital that we raise drives our fund management segment, which contributed 44% of total EBITDA last year, a 26% increase in contribution versus 2021. And the acquisition and integration of ARA Logos complements our existing fund management enterprise with synergistic impacts on the capital raising teams through an enhanced combined network of institutional investors, an expansion of investment products to provide more holistic solutions for our capital partners. From a business perspective, this capital that we've been able to raise has been well diversified across sectors, strategies, and geographies. The first pie chart on the left illustrates our focus on new economy assets. With US $58 billion, or nearly 70% of our fund AUM. But we also have a significant credit book, and as David mentioned, and a traditional value add funds and infrastructure that Kanish was talking about. In the middle pie chart, you can see that 66% of our book is in sticky core and core plus strategies. This strategy yields consistent, stable fee streams as we execute our vision to develop and hold stabilized income-generating assets for the long-term investors and expand our broad network of assets across Asia, which is such an advantage when creating occupancy solutions around the region for our tenants, like Trent was talking about. As the group continues to develop and stabilize our assets, the size of our core portfolio should continue to increase as we are effectively manufacturing modern core logistics in Asia, which we really view as infrastructure for the new economy. And this fuels our fund management business. And then finally on the right, our funds are broadly spread across our markets, with Asian countries still serving as the major contributor, taking up over 80% of our total private funds AUM. We've also been focusing on increasing our portfolio of APAC regional products, which now represents nearly 10% of our fund AUM versus our traditional country-specific vehicles. This expands the universe of potential investors, as the geographic diversification is a must for those real estate investors whom do not have the scale nor the expertise to allocate to one of our country-specific funds. 2022 represented the first year ever where regional capital raises at ESR outpaced country-specific raises, driven by our data center fund, infrastructure fund, Pan-APAC logistics development, and core funds, which all launched in the past 12 months. And while we have a well-diversified portfolio of fund products, we also have a well-diversified portfolio of investment partners dispersed across the world from a varied set of sovereign wealth funds, pensions, investment managers, and insurance companies, all looking to allocate into private equity real estate. We currently have a total of 203 capital partners in our investment vehicles. And as Stuart mentioned earlier, these not only include 12 of the top 20 largest global real estate LPs, but also our partnered list continues to grow, evidenced by the 28% of the dollars raised in 2022 stemmed from first-time LP relationships. Especially in these more challenging times, investors continue to seek to rationalize their manager relationships. Our chairman mentioned in his opening remarks that in tougher times, market leadership is further concentrated. Our scale, our breadth, our performance, and our focus on ESG makes us a trustworthy partner for these institutional investors, and we have successfully demonstrated the ability to port these capital relationships across borders. 13 of our 15 largest LPs have followed ESR to invest with us across multiple countries. While the teams in the region, as we've heard today, are on the ground executing, at the group level, we're constantly partnering with those teams, looking to leverage our unique platform to innovate and develop our capabilities with products to better serve our investment partners. Last year was not easy, but despite the challenges, ESR was able to continue to expand into complementary regions and sectors backed by our strong track record of success. Of the $7.6 billion of capital raised, nearly $3 billion represented firsts for ESR. Our first infrastructure fund and first regional data center fund, and our first life sciences deal, which should seed our new strategy as Luke described. These all represent new product and a new asset class. Our first regional logistics development fund, our first core fund in India, and our first co-branded ESR Regional Core Plus Fund, which is really the second co-branded venture with the merger of our Singapore REITs. These are all new, innovative products leveraging our core business. And then finally, our first Thailand asset acquisitions, which Jay described, among others, should seed our Southeast Asia strategy and represents the entry into the second largest economy in Southeast Asia. Several of these funds also evidence ESR's expansion into our suite of fully discretionary fund structures, which gives us more flexibility in terms of deployment and further diversifies our LP base. And while it's certainly easier to find capital when you have compelling platform in a compelling region, executing compelling strategies with a compelling track record, you also need a really good team to execute the kind of growth that ESR has experienced. The group capital team is structured with a central office here in Singapore with professionals on the ground across the region covering our core markets. The team is highly experienced, averaging over 21 years in industry in the leadership team alone, and very client-focused, targeting client-driven solutions. We have fully integrated the capital team with ARA and Logos, and the group capital team is now overseeing all fundraisers across the enlarged ESR group. This consolidation has several benefits, including creating synergies by combining investor relations of each business unit, leading to cross-fertilization of capital across the group. On Sunday, I'm off to Germany to meet with our ARA colleagues in Europe and meet several investors to discuss ESR, Logos, and ARA funds. Improving coordination on investor outreach, preventing overlapping discussions, and building a deeper relationship across the platform, consolidating our strategic importance to our clients, and broadening personal coverage provides us with complementary boots on the ground in each major market in Asia, Europe, and the US to help cover global investor relationships. You've heard all day about the key initiatives for 2023 in each of our markets. Looking at it holistically, you can see we're raising multiple new strategies in nearly every market where we operate, which we usually do. And despite the fundraising challenges, we feel confident that these funds will be closed over the next several quarters. Some of the key initiatives for 2023 include a focus on our core funds in Korea, Australia, China, Singapore, and India, and PACV, our first co-branded venture with Logos, and ESR's first Pan-Asian Core Plus Fund, which is in the market, which we think presents a unique, very attractive opportunity for investors to access a diversified portfolio of Core Plus modern logistics across Asia. We're also focused on final closes, on our successful data center fund, our Australia Development Fund 2, and our fourth Japan Development Fund. And continuing on with our strategy of innovation and product development, funds in new sector adjacencies, as discussed by Luke in life sciences and high-tech manufacturing, as Simon mentioned, as well as expanding our portfolio of regional and discretionary funds, such as our new Southeast Asia strategy. But none of this capital comes without demonstrable track record. To date, we've successfully fully realized a total of 13 funds consisting of 57 new economy assets. we're proud to present a strong weighted average track record of nearly 20% net realized IRR on a blend of core and development funds. When comparing our fund's performance against the Preqin APAC private real estate benchmark, we outperform by more than 700 basis points across our vintages. This alpha expands to 887 basis points when compared against the Preqin global benchmark, which includes between 90 and 146 funds in the vintages. This outperformance highlights our expertise in the sector and empowers the thesis for why capital providers partner with ESR. So in conclusion, it's an exciting time for ESR. We are aware of the current environment, but feel confident that we will be able to continue to earn the trust of our investors to deploy with us. The first key theme for us is continuing to leverage our competitive position. ESR has over 2,000 people on the ground as a native part of the real estate ecosystem across Asia, representing 95% of Asian GDP. No other real asset firm has that presence. Asia is very diverse. Real estate markets in Korea operate very differently than real estate markets in Japan, let alone India or Indonesia. This advantage uniquely positions us to capitalize on growth across the continent. The second key theme is positioning ESR as the capital gateway to Asia. For North American and European capital, we portray ourselves as the right catalyst to deploy their capital into Asia, and now we can do the same thing in reverse by shepherding Asian capital into Europe, where we already have over $20 billion of AUM. As we say in America, you can lead a horse to water, but you can't force him to drink. Our third key theme is that the investors need to get off the sidelines and execute on that 62.4% jump in RFPs that I referenced earlier. And we need to convince investors that the flip side of the relative value coin is relative risk, especially in terms of growth. Many investors tell me, why should I buy Asia when I can buy Europe and the US at higher yields as prices have fallen more? And that leads us to the fourth key theme, convincing investors. Why Asia now? Well, I believe that there are many compelling signals. Stock markets are up double digits since the fall of 2022. China's COVID lockdown is over, and the giant economy is getting back to work. The interest rate hike cycle is at or near its end. And despite the current noise in the marketplace, just remember the fundamentals that really excite us about this region. The continued e-commerce penetration, the emerging middle class, and more consumption. Starting with the massive population. 60% of the people in the world and nearly 15 times the population of the US in Asia. Rapid growth. GDP growth per capita here is projected to be 1.5 to 2 times the growth rate in the US and the EU in the coming years. The emerging middle class. Growth of this middle class in Asia is massive, with population growing at 8% in Asia of the middle class alone through 2030 versus negative 0.1 and negative 0.6 in the US and EU respectively. By 2030, Brookings Institute estimates the middle class population in Asia will be over 2.7 trillion people, over 4 times the size of the middle class in the US and EU combined. Think about that for a moment. If you combine the middle class populations of the US, EU, and the United States, Asia is projected to represent 80%. This creates an enormous consumer engine, the lifeblood of our business. When people buy more stuff, the supply chain needs to store more stuff. That's good for ESR. Brookings estimates the 2022 APAC middle class consumption at about $10.5 trillion. This figure is expected to nearly double to just below $20 trillion in 2030. That amount of consumption is forecast to be nearly 5 times the $4.36 trillion size of the projected US middle class market in 2030, which, by the way, is shrinking from 2022. Marinate on that for a minute. Nearly a $10 trillion increase in middle class consumption in Asia in 7 more years. Asia is forecast to build 2.5 brand new US middle class economies. We are focused on the right geography, we're in the right sector, and we have the right platform. And with the focus on ESG, we believe that ESR is and will be the leader to take advantage of these secular growth trends. Thank you. Take some questions.
Thank you, Josh, and hope you feel better or you will recover in the next 24 hours in order to make your trip.
Me too.
Okay, a few questions that have come in. Let me just pose them. So you mentioned, you made a point earlier in terms of, investors are sitting on the sidelines. So there is a question in terms of what is your view in terms of when these PRE investors will come out of the sidelines, and what do you think will drive that? And another related question to that would be, given the geopolitical tensions, are you seeing international capital pull out of any of the existing funds in China? And what is the appetite for future investments?
The double-headed question. So in terms of the investors in the sidelines, I think that, investors, and I was a fund-to-fund manager before, so sometimes I think with an LP hat, sometimes I get confused sometimes, but I understand why LPs are cautious in terms of their deployment. And, we have conversations every day. The interest level that we're finding now is very, very strong. People are keenly interested. They're inevitably under-allocated to Asia, under-allocated to logistics, and they want to deploy. But nobody wants to catch a falling knife. And this is the thing, is that do they want to buy assets now that they fear that 6 months from now the assets might be worth less? Having said that, I think that this is a unique time where investors, especially looking to build portfolios at scale, which is what we can provide, there are unique opportunities to acquire very high quality portfolios with very high quality managers that usually are not available. And so I think investors are looking at that strategically. And in the marketplace, there is this dichotomy of the investors who are just sitting on the sidelines and waiting, and the investors who have this kind of view of, look, we are in the forever business. We will deploy through vintage years. We will dollar cost average. And it's a unique opportunity to pick off deals. I actually personally think that this is an incredible time to be formulating capital to be opportunistic, because there are going to be and are already distressed opportunities to take advantage of the current environment. And in terms of the geopolitical tensions, I mean, clearly the geopolitical tensions with China are challenging for us in terms of attracting foreign capital to China. I mean, there's no two ways about it. The Canadians, the Americans, and many of the Europeans are pausing. However, we have found and it's proven, I mean, the domestic capital in China is really making up a lot of that, and those guys are licking their chops. And so there's a lot of new deployment and investment happening domestically and also in the Middle East. So, I recently was in the Middle East, and there's, very good, obviously, G2G relationships with the Middle Eastern capital and the Chinese government. Those guys are looking to deploy significant dollars, and I think we'll make up the gap.
That's good to know. Then, just following on that question, which markets and assets are investors most interested in?
Maybe all the CEOs can put your earmuffs on. I mean, it's a tough question, Marilyn. I think that, when I'm talking to investors, and as you guys can see from our list of varied products that we have within ESR, it's a much more consultative process, and it really depends upon what they're looking for. Some investors are looking for core, some are looking for more risk, some are looking for infrastructure, And so I think that the value of ESR is that we have the scale and the breadth and diversity to be able to provide those solutions depending upon what they want. I mean, look, we co-invest in everything that we do. We don't raise funds that we don't have conviction in. In terms of kind of relative risk and return, I think that's much more of a discussion depending upon which investors, what they want to accomplish.
That's a key strength for ESR, right? Yeah, exactly. Okay, so the third and the last question that we have is in terms of fee structures, just to give a flavor, whether there's been any movement in light of the current macroeconomic environment.
No, I actually don't think there has been. I do think that the dynamic between leverage between LPs and GPs does ebb and flow. I don't feel like we have really gotten a ton of pressure on our fees at all. It's more, again, just getting, the decisions are more binary for the investors. Like, are you going to go or are you going to sit? It's not about, well, if you cut your rates, 10 basis points, then I'll do it. So, yeah.
Okay. That's all the questions we have. Thank you, Josh.